Hello, everyone, and welcome to today's webinar, Rethinking LTIs, Adapting to New Standards for Performance Equity. I'm Ruth, the producer for today's webinar, and to improve internet bandwidth and ensure a smooth experience, we ask you to please close any unused browsers, apps, or anything that could potentially slow it down. You can communicate with your presenters today by using the Q&A pod and the chat section. Please use this for any content-related questions you might have, or if you experience technical difficulties. Any questions regarding the content of the presentation will be addressed at the end. Our presenters for today are Brooke and Brett. At this time, I would like to turn the floor over to Brooke. Take it away. Okay.
Brooke, I think you may be on mute.
Yep.
You think we would have learned by now?
Hi, was I on mute? Can you hear me?
Now we can hear you. You're good now, Brooke. You're good, Brooke. We can hear you.
Great. You can hear me? Thank you.
We can hear you. You're good.
Okay. Sorry about that, everyone. I'm having a little trouble with the speakers this morning. Brett, I'd love to introduce you. This is one of our managing directors here at Pearl Meyer. Brett's got quite a broad industry experience, works with clients across industries here for us. And we're going to be talking today about LTI. He's working at Pearl Meyer since 2008. I'll just tell you a little bit about Main Data Group as well. Main Data Group is the data services platform that is operated by Pearl Meyer, and we have a variety of different components to our data set that's from proxies. For example, we've got all the LTI we're going to be talking about today, and the data compiled here is from our data set, and it goes back about 15 years. My background's in software and technology, and we're here to talk to you about LTI today. The one thing I will say also about this webinar very quickly is we're not going to be offering any kind of a continuing education for this today. So onward and upward. Are you ready, Brett? Let's move on.
Perfect. Thanks, Brooke. I am ready. Good morning, good afternoon, good evening, I suppose, depending on where you are. Thanks for joining us here today. We have a great set of materials to cover. We have 3 poll questions, including one at the very end of the presentation. I'm very excited to get your opinions on, so I hope you stay with us until the end. As Ruth mentioned, we'll be monitoring the chat. If you have questions as we're moving through the materials, feel free to shoot a question over. If we have some good ones, we'll answer as we move through the presentation. We may save a few for the end, and Brooke and I are certainly positioned to answer questions offline as well. So away we go. Interesting times in executive compensation, to say the least. Companies continue to evaluate kind of all elements of executive pay, salary, bonus plans, long-term incentive plans, perquisites. Security arrangements are back in the news after what happened in Manhattan last December with the United Healthcare exec. We've seen a continued retreat from formal linkages to DEI in executive compensation plans. SEC disclosure requirements back on the docket for the first time since roughly 2008, I believe. I think we can all agree that SEC pay versus performance requirements are so much work, and we'd all like to put that to, forget that ever happened. And then lastly, trying to make sense of the current economic environment. The stock market continues to do extraordinarily well. It seems like the industrial averages are hitting new highs every day. The concerns may be that stock prices are really disconnected from underlying fundamentals given ongoing tariffs, the tariff situation, stubborn inflation. So what all that means from an executive compensation perspective, not sure, but I will tell you that it remains very interesting from a day-to-day basis. We're obviously getting to the point in the year where proxy advisors are doing their annual update of voting policies. We all know that companies feel somewhat compelled to align with those proxy investor, voting standards. And I'm here to tell you today that some of the changes in proxy advisor voting standards around long-term incentive practices may lead to some of the most meaningful change in LTI design, kind of going back to the rise of relative TSR plans 15 years ago. And so it's really important that we're having this discussion today so that you all are prepared for the next few years as these decisions and discussions continue to evolve. Brooke, can we go on to the next slide? So how did we get here? Let's rewind the tape just a minute. So going back to pre-2005, you had something called APB 25 that basically allowed companies to grant as many stock options as they wanted without ever having to take an expense for those options. In 1996, the Financial Accounting Standards Board issued a draft rule around stock option expensing, encouraging companies to expense their awards. Some companies decided to go ahead and expense. There were certainly a minority of companies that did, really driven by investor pressures and general governance issues. And after some accounting scandals in the early 2000s, you had some more companies that started to voluntarily expense stock options as they were granted. Finally, in 2005, with the implementation of FAS 123R, that mandated stock option expensing, the playing field for long-term incentives was essentially leveled, and all types of equity awards were required to, incurred an earnings charge. But in 2006, you had the SEC disclosure enhancements that I mentioned on the prior page that ultimately led to a lot of substantial modification around disclosure requirements. Investors now had access to a lot more information and data, highly standardized, allowed companies like ISS and Glass Lewis to take that information and data and really create a platform to advise institutional investors over the various issues that shareholders have a right to vote on. Companies really seeking to stay in the good graces of the proxy advisors really adopted practices that were generically considered best practices, relative TSR plans, and some other kind of questionable comp practices. We've been operating in this this environment now for probably 10 to 12 years, which really brings us to where we are today. And let's talk on the next page about where that is. So if we think about where we are now and what led us to today, we have a portfolio approach to long-term incentives. And what we mean by that is companies are generally not delivering all of their LTI in a single vehicle. Two vehicles is actually the most common approach to executive LTI across the S&P 500. Almost 60% of companies are using two LTI instruments. You have a slightly more than 25% of companies using three LTI instruments, but very few companies are using a single LTI instrument. You have a very heavy emphasis on performance-based long-term incentives, and this will be a recurring theme as part of this discussion. We have a decline in the use of stock options, as I mentioned on the prior page, with the mandatory expensing, investor and shareholder concerns over dilution. The fact that neither ISS nor Glass Lewis consider stock options to be performance-based. You've really had this decline in stock options as the primary LTI vehicle. The rise of performance shares, or PSUs, as the primary LTI instrument. PSUs really check the box in a lot of terms, and from a simplicity perspective, they minimize some shareholder dilution, some generally favorable accounting treatment, good alignment with investors. RSUs continue to have play a major role in the LTI strategy for a lot of companies, providing kind of good balance to the retention objectives that companies try to achieve with their LTI strategy. And finally, you have the increased scrutiny from the proxy advisors. It's a continuing battle that companies have to address every year as they issue their proxy statement and ensure that they try to get shareholder support across the various compensation issues that shareholders vote on. Now I'm gonna let Brooke talk a little bit about the chart here on the right-hand side of the page. I think Brooke may still be dealing with her technical difficulties. What you see on the right-hand side of the chart, on the right-hand side of the page there, LTI vehicle prevalence across the S&P 500. You can see back in 2004, nearly 100% usage of stock options across the S&P 500. Obviously, as mandatory expensing of stock options with FAS 123R, you had companies kind of diversify their LTI practices. And you move to 2024, kind of the last year of data that we have available. You can see that PSUs have essentially replaced stock options as the vehicle of choice across the S&P 500. And we have nearly 3/4 of companies using RSUs. Stock options still being used by slightly more than 1/4 of companies, but not the universal usage that we saw roughly 20 years ago. Obviously this data set covers the entire S&P 500. Certainly when you dig in to the data by industry, by business maturity level, by talent markets, you certainly see differences in LTI usage, but certainly when you look across industries, PSUs are by far the most common long-term incentive instrument. Now we'll go ahead and Brooke, can we move on to page 6? So we've talked a little bit about the proxy advisors. So who are the proxy advisors? What are the proxy advisors? The proxy advisors are those, they're essentially professional services firms that are advising institutional investors on how to vote their shares. They develop their voting recommendations based on what are called voting policies that the proxy advisors develop. The voting policies cover all the routine matters, approval of the auditors, director elections, management say on pay vote, as well as the non-routine matters, articles of incorporation, changes in stock exchanges, large corporate transactions. Those voting policies really cover all elements, all items that shareholders have a vote on. The proxy advisors, don't make the rules. They don't create the voting policy, but their influence is massive. Companies in general try to meet the proxy advisor standards to ensure investor support, simply because of the amount of influence that the proxy advisors have in shareholder voting. So if we talk about shareholder voting and the role of proxy advisors from a compensation perspective, we first start with kind of understanding the say on pay impact proxy advisor voting recommendations. So a no vote recommendation from ISS is worth about 25% of investor support. If we focus on Glass Lewis, they have a little less influence. So a no vote recommendation from Glass Lewis is worth roughly 8 to 10 percentage points in terms of support for a say on pay vote. A no vote recommendation from ISS and Glass Lewis, we generally expect a 35% hit on the support for management say on pay. So this oversized or this outsized influence has really led to a pressure to conform from a compensation design perspective. It's ultimately driving kind of this homogenization of pay practices and a real reluctance to consider things that are kind of strategies that are outside standard market practice or innovative approaches. It's led to some what we call best practices or these one size fits all standards and policy. One of which is a policy that companies should be delivering at least 50% of their LTI in performance-based vehicles. And this idea that companies should be delivering a majority of LTI in performance-based vehicles, this is going to be a recurring theme as part of our discussion here this morning. So we're definitely going to come back to this. But companies really feel pressured to meet these one size fits all standards. And I'm going to go ahead and just push back on this for a moment. We think that as compensation consultants, boards, management teams should be empowered to really step outside some of the conventional wisdom that exists around executive compensation. For the longest of time, the United States has really been a beacon of innovation. And if companies feel compelled to kind of conform to these best practices, I think there's some concern that eventually the United States as a beacon of innovation may be tempered. I think there's real concern that the proxy advisors have too much power, and they are under some scrutiny. Although the proxy advisors won a case in the DC Circuit Court to kind of evade from SEC oversight, they are under some pressure in some state courts to create some state level oversight. So there is a sense maybe the pendulum is maybe slowly swinging back the other direction. And companies, I think, do feel compelled to maybe push back against proxy advisors more so than they did 10, 15 years ago. Now, I do want to say something good about the proxy advisors. The proxy advisors have done a really good job of creating some accountability for what might call red flag practices. So if you go back 15, 20 years, there were certainly some things that companies did that really went against kind of what we may say good corporate governance standards. And the proxy advisors have actually been really good about pressuring companies to move away from some of those practices. So they certainly have done some good things. Let's move on to the next page, Brooke. So how do the proxy advisors, ISS and Glass Lewis, consider the opinions of institutional investors and companies? Well, there's a couple of ways. The biggest way is through annual policy surveys. So each year, ISS and Glass Lewis conduct these policy surveys where they go out to asset managers and solicit their opinions on a range of practices, compensation related as well as non-compensation related. They run these policy surveys in late summer. ISS just closed their policy survey in late August. Glass Lewis just closed their policy survey on Monday. Both proxy advisors will formally issue their voting policy updates in that November/December timeframe. And they take all of the feedback they receive from the policy surveys and issue voting policy updates in November/December. Last year's survey and last year's voting policy updates, as well as this year's voting policy surveys, there was a particular focus on executive long-term incentives and specific questions as to whether ISS and Glass Lewis should consider relaxing this standard that at least 50% of LTI should be delivered in performance-based equity. Also questions around the role of extended vesting requirements, as well as holding period requirements, and whether extended vesting requirements or more rigorous holding period requirements can mitigate pay for performance misalignment. And lastly, really understanding the types of circumstances in which granting time-based equity may be acceptable. And I just want to ensure that we're on the same page around what a vesting requirement is or what a holding period requirement is. A vesting requirement is the time and or performance conditions that must be met before an executive can gain full ownership of an equity award. So it's the mandatory service requirements, time and or performance. A holding period requirement means that even after an award has vested, an executive must continue to hold some portion of the shares received from either the vesting of the award or the exercise of the award for some period of time before those shares can be sold. So it ensures some ongoing exposure to stock prices. An executive can't immediately turn around and sell the shares right after they've been earned or received. And again, this is something that has been in the news for a while, and it will continue to show up as part of proxy advisor voting policy. Before we broadly review the feedback that the proxy advisors received on these specific executive compensation topics, let's look at the opinions of a particularly vocal investor. Brooke, can we move to page 8? Oh, I think we went one page too far. Oh. One more page forward. There we go. A spotlight on Norges Bank Investment Management. Whereas most institutional investors and asset managers prefer to quietly engage with their portfolio companies or quietly engage with the proxy advisors, Norges Bank Investment Management takes the opposite approach, very vocal. They sat in on the SEC roundtable discussing executive compensation back in late June and were particularly vocal in that discussion. They publicly issued letters when ISS and Glass Lewis issued their annual policy surveys earlier this summer. So who is the Norges Bank Investment Management? Well, the NBIM is the Norwegian Sovereign Wealth Fund, is one of the world's largest sovereign wealth funds, holding about $1.6 trillion of assets and owns about 1.5% of global equity values. So they are a big player across the world in terms of their ownership and their influence. They have not surprisingly, they have a very European view of executive compensation. generally advocating for very simple executive pay arrangements. They believe that PSUs are performance share units, again, are overly complex, non-transparent. They contribute to some short-term thinking and some suboptimal decision-making because they're focused on three-year performance cycles. Their research suggests that most frequently PSUs fund above target, fund more frequently above target than below target. And so they're generally favoring executives at the expense of shareholders. And when they don't fund the way that companies want them to, companies end up, approving one-time equity grants. They adjust results to create a more favorable outcome for management. And they also think because of the leverage that is built in from funding these types of awards above and below target, that executives are somewhat insulated from stock price performance. Whereas I think a lot of people view the additional leverage from the change in the stock price, within a PSU cycle. The NBIM views that as a bug or an undesirable feature of PSU plans. The NBIM really believes that companies ought to deliver very simple LTI grants in time-based equity with extended vesting requirements, 5 to 10 years, and holding period requirements that extend to or beyond retirement. And both of those features really lengthen the time that an executive is exposed to stock price performance. Again, very much a leading advocate and a very vocal advocate to drive changes in executive LTI programs. I think this is going to take us, Ruth, to our first poll question. Which I think Ruth is getting up on the screen for us now. So one of the things that we've mentioned here is that the proxy advisors, ISS and Glass Lewis, do not consider stock options. Oh, I'm sorry, I'm looking at the wrong poll question. So again, NBIM has talked about delivering RSUs with extended vesting requirements or subjecting equity compensation to extended holding period requirements. So the question is, at your company, have you had any internal discussion about potential changes to LTI consistent with the NBIM's position? And you can see the options there on the screen. Give you a few more seconds to put your vote in, and then hopefully we can get a live look at how our attendees have voted here this morning. And Ruth, I cannot, I guess I'm not seeing if the results are being displayed yet. I'm hoping that you can chime in when we're getting the results up on the screen.
From what I can see, Brett, it's about 78% have said no, it hasn't been a part of our LTI strategy, and about roughly 18% are saying they're aware of the NBIM's perspective, but haven't.
Excellent. Well, I think that I'm not surprised.
But everyone's vastly in the no bucket. Yeah.
Well, I'm not surprised, because I think this is very much an emerging issue, and I think our discussion today is very much focused on, evolving trends. And this is one where, the discussions are really getting started right now. And I don't really think this is necessarily impacting the current discussions around, what do we do with our LTI plan right now. I think companies are starting to think about how we may evolve our LTI plans here over, what evolution may look like here over the next few years.
Next slide.
Excellent. Yeah, let's move on. Are you back with us, Brooke?
I am back. Sorry about that, folks. I was having some speaker issues, but I can hear everything now. I can hear
Excellent.
all the opining you're doing, Brett. Keep going. Doing a great
Perfect.
job.
Awesome. So now that we looked at what the NBIM said in terms of their feedback around executive LTI, let's take a moment to look at the last round of broader investors' feedback on these specific questions around extended vesting restrictions and holding period requirements. So I don't think, as we kind of evaluated the investor feedback in the last round of policy surveys, I don't think we saw anything that was a surprise. ISS and Glass Lewis, they asked slightly different questions, but the scope of the feedback they received from the questions was somewhat similar. With ISS policy survey, you had quite a number of investors that were really thought that long vesting, time-based equity, extended vesting requirements on time-based equity could be considered a mitigating factor when a company had a pay for performance disconnect. Across the full population of responses, feedback was a bit more mixed and balanced. I think it certainly came across loud and clear that investors still like performance shares, but I think investors were signaling that they have an open mind to differentiating between 3-year ratable vesting and something that's more like 5-year or even 7-year vesting on time-based equity, and those are very different practices. You also had a lot of investors supporting post-vest holding requirements. Non-investors, less so. Not surprisingly, these are, non-investors you have a lot of company executives responding to the survey. They are looking to maximize their ability and flexibility to monetize their equity awards when it makes the most sense, not necessarily looking to have their opportunities to monetize restricted in any way. As we looked at the Glass Lewis policy survey respondents, again, investors still like performance shares. Time-based equity awards, generally, Glass Lewis survey respondents not in favor of, except when the grant size is smaller, vesting provisions extend for a longer period of time, or there are some post-vest holding requirements. Investors continue to express concerns over overly complex plans and some of the other standard concerns that show up with compensation. And just to say, with respect to the Glass Lewis policy survey feedback, the concerns are not new. This is a concern with every institutional investor. They want good disclosure. They want straightforward plans. They want good rationale for executive compensation decision making. Let's move on to the next slide. So as we think about, as we looked at changes to proxy advisor voting policies for this year, what came out of last year's policy survey, changes were fairly modest around performance-based equity. ISS, there were no formal policy changes. ISS offered some clarifications that really boil down to concerns over lack of transparency. And if a company had a pay for performance disconnect, any lack of transparency going to weigh heavily in the voting recommendations that ISS would issue. As we look at Glass Lewis in terms of changes to their voting policy, it was a lot of words that they used, a lot of a red text to basically say, we're not changing anything, but we're just telling investors and issuers that we're going to undertake a holistic assessment of executive compensation. And we will continue to evaluate every company on a case-by-case basis, which I think from an investor perspective and an issuer perspective is a good thing, right? You don't want to be subject to a one-size-fits-all policy. Glass Lewis did say that post-vest holding requirements viewed favorably, and stock options still not considered performance-based. All this to say that we expect more extensive changes to proxy advisor voting policies around performance-based equity in 2026. So the advice to clients: continue to focus on transparent disclosures and demonstrating how executive compensation decisions are aligned with business results and your human capital needs. So with that, we will move on to our next poll question.
Poll number 2.
So, as I just mentioned on the prior page, neither ISS nor Glass Lewis consider stock options to be performance-based. Do you consider stock options to be performance-based? 2 options, very black and white. Yes, stock options are performance-based because executives only recognize value if our stock price goes up. Or no, stock options are not performance-based because a rising tide will float all boats, even the boats that have holes in the hull. So curious what you all think about stock options. Are they performance-based?
Getting a little bit more variability here on this one.
Give it a few more seconds here. I do think some companies get a pass on this question. When ISS and Glass Lewis issue their annual voting recommendations on particular companies. And I do think this is one place where, a company that would deliver 100% of LTI and RSUs versus a company that would deliver 100% of LTI and stock options. You can't consider those 2 companies equivalent from an LTI perspective. Very different LTI structures, just because neither is delivering LTI in a performance-based vehicle. If you use ISS and Glass Lewis's definitions, doesn't mean that one is better or worse than the other. I think it just means that they have very different LTI strategies. It's a very simplistic view, and I think what you see in the results from the attendees here, Brooke, is that we do have some diversity of opinion.
Well, it's evenly split almost. It's just a little bit more yes than no, but pretty evenly split.
No, it's good. It's good.
Yeah,
Um,
it's all in the context of, like you're saying, the LTI strategy. Like you said, you can't just view this one measure and say this is this one measure that we're looking at, and this is how ISS is going to vote based on this one measure. It's all in the context of the strategy and the performance of the company, the metrics that are attached to the performance shares. All of those things matter. It's a contextual application of the policy.
100% agree. But before we move on, just one last quick point on Glass Lewis. Glass Lewis has already actually announced some upcoming changes for this coming proxy season that I think everyone will be, the issuers, that asset managers will view very positively. I'm not going to spend time talking about them just because we haven't got a whole lot of background and context, but Glass Lewis has already highlighted some changes they're making next year, not specific to how they may view performance-based equity, but how they view pay and performance alignment, kind of at a summary, high level.
Ready to move on?
Excellent. I think we are.
Yeah, let's talk about some data. I think this is the section of the presentation where we really kind of dive into some of the metrics we're seeing out there and some of the prevalence data just across LTI policies in the market. And kind of we did some analysis using the main data group data. And I think it's not surprising, based even on the very first chart we saw going back to 2004, people are really kind of focusing on moving things into the performance share space, right? 90% of the CEOs in the S&P 500 have this component as part of their package. You've seen kind of a reduction in the use of time-based stock options. Again, this kind of dates back to what we saw in the very first chart. So not really surprising here, but you're seeing a lot of movement into time-based RSUs and performance share units. For all the reasons that we're talking about. It's easier to benchmark the results, tie them to measures, tie them to metrics that you care about. So this is very popular. And back to kind of the homogenization around like ISS's voting and ISS's kind of focus on these areas. This is kind of their way of influencing what boards are doing. Anything else to add here, Brett? Not surprising.
No, I think no one's surprised by this data. I think, actually, I take that back. I think the one surprising thing was how low the prevalence of LTI performance cash is. I think generally in practice, we might say probably 10 to 15%, but coming out at only 4%, I guess I was just caught a little off guard.
How low that was.
Yeah.
Great. What are we looking at in terms of weighting? It's looking like around, on average, you're seeing 62% of CEO equity granted in performance stocks. So across the components that have equity in them, you're seeing this kind of 62%. Everything else is kind of evenly split at 30, 30, 28. So obviously the N of 445 folks that had a component, 62% of them have performance share units, 36 time-based RSUs, 31% time-based stock options, and 28% LTI performance cash. So this is a kind of, again, not surprising. Performance share units seem to carry the day in a variety of contexts. Anything else to add here?
Yeah, one comment here. I think the one size fits all policy that companies ought to be delivering at least 50% of their LTI and performance-based equity, that starts to show up in this stat where 62% of LTI is being delivered in that PSU instrument. I know we get a little more granular in a later slide, Brooke, but I think that's where companies say, okay, if we're going to comply with the standard or the best practice, that's what it looks like. And this is how it starts to show from a data perspective.
Now, also we're seeing, as far as the vesting schedules, like you're saying, folks are complying with the ISS best practice. They're moving things into performance-based units, either stock or RSUs. It's looking like slightly more common for stock options to have a longer vesting period than restricted stock and RSU, and only 3% and 7% of the companies had vesting periods longer than 4 years. So this is, again, not surprising. A 3-year time horizon looks like it's the vast majority, or 3 to 4, overwhelmingly is where people are landing their vesting schedules to get that real kind of long-term kind of aspect to the performance and to the governance that they're looking for. Anything to add here?
Yeah, I guess the only thing that I would add is that if we start to see companies evolve their LTI strategy and consider extended vesting requirements, you're going to see the shape of these bar charts start to flatten out on the short end and get a little taller on the back end. You know, it certainly won't do a flip flop. But you certainly can see that 71 and 58 going down, and the greater than 4 years starting to push up. But again, we're still a few years off from that happening, so it's good to see it kind of as a current benchmark.
Yeah, and later on in the deck, we'll talk a little bit about some examples that are already in the 5-year window, right? So we are seeing it once, here and there, but like you're saying, that's kind of where things are going. It's not going to get shorter, I guess is the point.
It will not get shorter, that's for sure.
Yeah. So, all right. What we're looking at in terms of percentage of performance-based LTI, again, across the entire S&P 500, are at 449 of the companies that granted performance LTI to the CEO, 85% granted at least 50% in LTI performance-based awards. And this is, again, consistent with the best practice that we're seeing from Glass Lewis and ISS. We have a really nice bell curve. But, I mean, the point here is people are putting 50% or longer or more into these buckets in terms of 50%, 60%, and then 70%. That's, vast majority of the results here on this page out of the 449. Anything to add here in terms of the performance-based LTI measures?
The only thing that I would add, I was a little surprised that we had 85% of companies kind of aligning with the ISS Glass Lewis standard. I thought it would have been a little less. I thought we would have seen a higher water mark of maybe 75. So 85 suggests that there are a lot of companies that view that ISS and Glass Lewis standard as, a line that we're not willing to cross right now.
But also maybe it's also suggestive of alignment and with management alignment with comp committee and governance along this line that, yes, we should be looking at performance-based LTI in this way, right? That could be also just signaling alignment across the S&P 500. Also, it could be signaling maturity too. Like we're looking at very mature companies, right?
Absolutely, we are looking at very mature companies. I guess I'd also note that there's only 449 companies in this sample. This sample excludes the 51 companies that are either granting RSUs only, granting stock options only, or granting RSUs and stock options. So they are not delivering any performance-based equity in the eyes of ISS and Glass Lewis. So, there is a hidden bar at 0% at the far left. If those companies have been able to resist these ISS and Glass Lewis and institutional investor standards thus far, I don't think the current environment is going to push them to necessarily adopt a majority performance-based equity strategy now.
Yeah. All right. Now we're looking at stock ownership guidelines as a multiple of salary. Again, across the S&P 500, 477 companies, 96% disclose that the CEO has a stock ownership guideline, with 461 referencing the CEO's salary as the multiplier as the guidance measure. 58% of the S&P 500 companies set the CEO ownership as a multiple of 6x salary. So you see the pretty significant play here at 58% at 6x, 12% at 7 to 8. So you're, 2/3 are over 6x on their multiple, with a tiny percentage, only under 15% below 5x salary. Any thoughts here on the stock ownership guidelines of like how people are honing in on the 6x number and 6, 7, 8x number?
Yeah, I think it's just a question of market practice, and 6x seems to be the standard. I will say that when you consider the focus of the policy surveys and the focus within the policy surveys on extended vesting requirements or holding period requirements as features to increase exposure to stock price and value. This is another lever that companies have available to increase that exposure to stock prices by requiring executives to hold more stock. So I'm a bit surprised that the voting policy surveys and the expected evolution in voting policy doesn't explicitly consider more rigorous ownership guidelines, because again, it is another way that companies can and institutional investors can create accountability and increase that linkage to general stock prices.
Right. Skin in the game. Yep.
Exactly.
Yep. All right. We've got about 10 minutes left, so I want to kind of quickly jump through these final slides and get into some of the qualitative examples we have at the end, Brett. So we're just going to quickly jump through these. Back into the holding period requirements. As you can see here, 315 companies, or 63% of the S&P 500 CEOs have holding period requirement for the CEO and other senior executives. Most commonly, the HPR is effective until the ownership requirement is achieved, so about half the cases there, and then and it's not achieved around 29% of the cases. A minority of the companies use multiple HPRs. So, for example, it will be split like half the net shares of the guideline are not met in 5 years, and then it'll increase to 100. So there's this kind of variability in the plan based on kind of where you're at in a certain time point. So you have no at 37% and yes at 63% to the question of whether there is a holding requirement prevalent. So obviously 63%, the vast majority of people are people out there with the holding period requirement. So any other thoughts on this before we kind of move on?
No, this data is exactly what I thought it would be. So yep. No surprises here.
Great. Onward. Now, what we're also seeing on the holding period requirement is you're either in the 50% bucket or 100% bucket. There's kind of like not much room in there for variability. Around 82% of the S&P 500 fall into one of these two categories. So for the 155 companies that provide it, 41% require 50% of the net shares to be retained, and 41% of the companies require 100% of the net shares to be retained. So either at half or 100. That's kind of where this is breaking down.
75%. It would be the answer today.
Then 12% of the companies require 75% of the net shares to be retained. So it's very, very, kind of one or the other, either in the 50% category or 100. So onward, here we go. So Brett, tell us a little about the prevalence of the measures that we're tying to the performance equity that we're seeing in the market.
Yeah, originally I didn't have this slide. We didn't have this slide in here, but someone said, why don't you talk about metrics at all? This discussion this morning, this afternoon, depending on where you are, not focused on PSU metrics. So we kind of threw this in here at the last minute. Key takeaway, relative TSR/stock price metrics continue to be by a wide margin the most common PSU metrics across the S&P 500. No surprises. Let's move to the next page, Brooke, just in the interest of time.
Yep. Go ahead.
There's no silver bullet on performance measure selection. focus on the most relevant measures for your company. Relative TSR, while it's simple, has its limitations. And I'm not going to read everything on this page, but the one thing I will say is goal calibration and where you set performance goals is as important, if not more important, than performance measure selection. So if you're going to spend time and money on something, spend it on goal calibration and not measure selection.
Mm-hmm. All right, let's talk a little bit about some unique cases in the market. We were talking earlier in the presentation. We're going to get to this, and we're going to kind of whip through this quickly and then open up for some questions in a second. So we've seen an Old Dominion freight line, for example, 53% RSUs, 47% PSUs, 3-year ratable on the RSUs, 6x CEO base salary for the stock ownership guidelines, and 50% net shares until SOG achieve 50% net shares vesting exercise for 1 year. So this is all kind of falling into place as far as what we've shown as far as the best practices in the industry. They're kind of ticking through kind of what's typical. Keurig Dr. Pepper has a bit of a longer, 10x base salary of the stock ownership guidelines, so much higher than 6x. So that's kind of unique on theirs. And again, a longer ratable vesting schedule on the RSU. So as we mentioned earlier, this is one of those examples where you're going from a 3-year vesting cycle into seeing longer vesting cycles. And again, the holding requirements typical on Keurig Dr. Pepper. Any other thoughts on kind of what's unique about these? And we'll have Brett do too as well here.
Yeah, so Old Dominion, right? They're out of compliance with this one size fits all policy to deliver 50% of LTI and PSUs, and but they have a 1-year holding period requirement on vesting or exercise on shares received from vesting or stock option exercises. So they may, if they had a pay for performance disconnect, they may get some relief were ISS and Glass Lewis to really formalize a policy to give to, for complying with an evolving standard. Mm-hmm. Same thing with Dr. Pepper. You're 100% time-based RSUs. They have this extended vesting requirement. Had they had a simple 3-year vesting requirement, they probably get no relief from ISS and or Glass Lewis if they have a pay for performance disconnect, but they may get some relief simply because of that extended vesting requirement.
Right. Let's see what's going on with Juniper and AutoZone.
Yeah, we'll pass over Juniper because I think AutoZone is a more interesting example. Mm-hmm. AutoZone still can, for the longest time has been 100% options with 4-year ratable vesting, and the holding period requirement only comes into play if the stock ownership guideline is not reached within 5 years. AutoZone has been a really, really strong performer for a very long period of time. And so they really haven't had to deal with a big pay for performance disconnect. You can certainly imagine if they go through a period of time in which they struggle, that ISS and Glass Lewis will certainly take the opportunity to shake their finger at AutoZone and say, you are not delivering a sufficient amount of compensation in a performance-based instrument. But to date, that has not yet happened.
Yeah. Okay. Do we want to quickly wrap up and move to questions?
Yeah. I want to be sure we answer 1 or 2 questions because we said we would. But real quick, what do we think happens here? As we think about Glass Lewis and ISS and evolution in voting policies, I think this year we'll see a very subtle but very important change, and then we will see a formal dismissal of this one size fits all policy that at least 50% of LTI should be delivered in performance-based equity. And they will simply say, proxy advisors will simply say, if you're not going to do that, we will offer relief on a pay for performance disconnect. If time-based equity vests no earlier than 5 years, or you have a post-vest holding period requirement of 1 to 2 years. So I think we're generally counting on seeing a relaxation of this standard. I think there is some investor fatigue with overly complex PSU structures. We will see companies move to either simpler PSU structures, or we could see companies say, you know what, let's get rid of these overly complex PSU structures and deliver equity, more equity in time-based instruments with some extended vesting requirements or extended holding period requirements. And then lastly, again, I can't overemphasize enough the importance of good disclosure. I was on a call with an ISS representative probably 6 weeks ago. She said that big numbers can be overcome with great disclosures. And so the biggest opportunity for most companies is with LTI. And so really, if you have a challenging story, if you have a challenging PSU program, really focus on the quality of your disclosure.
Great. So you got two questions. Yep. Thank you, Brett. We have two questions that came up during the discussion here. So one is, the question is, I would like to think that companies expect CEOs to be in that role for less than 5 years. For example, if your company expects you to be in a CEO saddle for under 5 years, does it make sense to have long-term vesting or holding requirements? I think that's one of the things too. It's kind of on its face. It's like, well, if you're going to be in the role less than 5 years, what does make sense, right? Because I guess the assumption is with all these holding requirements, what we're talking about so far is, assumptions around the tenure of the CEO as well tied to this.
Right. So I think it's a good question. And I think it remains to be seen exactly how that, this conflict will be addressed in the context of LTI. You're absolutely right that CEO tenure has been trending down. I think the question that I would ask would be, are companies doing enough to ensure that they are that the CEO selection process is resulting in the right decisions with respect to CEO succession? If companies are hiring a CEO and the CEO is only in the role for 2 to 3 years, I would sit here and tell you with a very straight face that company made a bad hire. So I think companies are better off focusing on making the right CEO, the right executive hires. And then I think the compensation issue will take care of itself. And what I think this structure does do for companies is it creates a very strong holding power within those executive LTI arrangements. So the short executive tenure issue is a symptom of a bigger problem. We don't have a compensation issue. We have an executive talent selection issue.
Right. And like you said, kind of no compensation tweaking or adjustments to LTI are going to fix that, right?
Absolutely.
That's not the mechanism by which you're going to try and get at this. So, right. Okay, moving on. We have a question here. Are RSUs preferred by NBIM as compared with TSR-based LTI?
Ooh, interesting question. You would think that NBIM would look at the various flavors of LTI arrangements and say, you can't mess with relative TSR, right? It is an external calculation that can't be managed. It can't be mitigated. We can't do anything to manage our TSR. And so you would think that NBIM would look at that and say, okay, that's fine. Well, let's do PSUs based on TSR. when you actually look at the statements that that NBIM has made, they haven't they haven't what's the word I'm looking for? They haven't hedged their position at all. They've really said very unequivocally that we believe time-based equity with extended vesting provisions is superior to all of the other types of LTI arrangements. So I would say no, or I would say yes, they prefer time-based equity with extended vesting, and any arrangements that directly tie to financial results or TSR results are in conflict for what we're looking for. One last comment. The other comment that they kind of concluded in the letters that they've issued is that all equity is eventually a performance share because it is tied to stock price.
Right.
And so whether it's a time-based share or it's a TSR-based PSU, it is still a performance-based instrument.
Okay.
So,
That's it. Thank you. Oh, we have one more from Thomas Ellis. We're going to hit that one. Before we go, though, I just want to make a comment about recertification credits. I just want to remind everyone there are no recert credits available for this webinar. Thank you for joining us. We have one more question, though. Can we take one more question, Brett, before we jump off?
Yep.
We have Thomas Ellis here. Do you anticipate a move to homogeneity for European companies with US-based operations? There continues to be a major philosophical difference right now. And will this philosophical difference continue? What do you think?
Good question. I saw a chart earlier this week that was specific to the UK and basically made the case that the UK has been losing stock listings and IPOs to other jurisdictions because the executive compensation requirements specific to UK listed companies were so onerous that it was impacting their ability to compete for executive talent. So certainly within the UK, I've seen the case get made that the UK executive comp model needs to evolve for the UK listed companies to remain competitive. Whether that's the same case in other European markets, I don't know. But I would certainly say, based on what I've seen in the UK and what a trusted resource has concluded, you wouldn't be surprised to see a relaxation of standards as the world and as geographies and talent markets are interconnected and business friction, is eroded. So I think it continues.
Yeah. Stay tuned. Thank you. All right, Ruth, are we closing this out today?
Sorry for going over, everyone. Appreciate your.
All right, thanks for sticking around for the question.
All right. Thank you so much, Brooke. Thank you so much, Brett, also for your time and your knowledge. This webinar will be available for playback for up to 90 days. Simply log in to world@work.org and access your profile. Please allow 24 hours for the playback to appear. Thank you to everyone for joining this webinar. This will conclude today's webinar.
Great. Thank you.
Take care.
Thank you.